it sounds a bit corny in a way, but really, a lot of, particularly the founders and the people that get with them, this is what they've decided to spend their life doing, building a company from scratch. And to be able to, it's a real privilege and very satisfying to be able to pass on wisdom and knowledge that helps people get to where they want to go in life. I get a lot of satisfaction out of that.
G'day and welcome back to Shares for Beginners. Now, when we think of shares, we generally think of single companies that are listed on the stock market. But this is not always the case. Some shares allow you to access investments that are generally beyond the scope of individual investors, such is the case with Bailador, ASX code BTI. Now, Bailador is a specialist investor in growth stage information technology businesses, and I'm pleased to welcome our guest today, David Kirk, co-founder and partner. G'day, David.
Good morning.
Okay, now David's the former chief exec. Well, actually, he's got a resume as long as your arm, but we're not going to go through everything today. David's the former chief executive of Fairfax Media, the chairman of Trade Me and Kathmandu, as well as a director on several other boards, and he was also the captain of the All Blacks when they won the World Cup in 1987, many moons ago.
Many moons ago. It seems a long time ago now. We just had our 7th World Cup. That was the first.
We're talking about Bailador and what Bailador invests in, and I mentioned that it's growth stage businesses. What is a growth stage business?
It's quite specific to information technology. It's a term used. Synonymous term is expansion stage, and that gives you a good idea. It's not investing in startup companies, small companies with a good idea, a couple of founders keen to build some tech and find some customers and have a business sometime in the future. It's investing in established businesses which are at a point in their sort of growth curve where they're ready to grow fast, but they need capital. Typically in the Australian market, that would mean the business had $5 to $10 million worth of revenue, was growing at 30, 40, 50, 60%, even a year, was well established in Australia and New Zealand, had a good customer base, it's proven technology, it knew how to win new customers, and there was enough financial information about the company to be able to assess its value and its prospects carefully. And that's the stage at which we invest. And very often for Australian companies, given that this part of the world is not huge compared to the rest of it, they're about to or have just begun to go international as well. And that will typically be to the United States or North America generally, or Europe, often starting in the UK because of the language.
Yep. So generally in these kind of companies, you would normally list to get that capital. So you're providing an alternative to these companies rather than listing on the Australian share market?
Yeah, I mean, listing is an alternative for companies that are about the size that we invest in them, but often it's just a bit too early for them. One of the things about listing, I think it's very important, and we've seen this quite a bit in companies that list a bit too early. If their revenue and their earnings are not predictable, they can, swing wildly in terms of their valuations. People can get very excited about them because the revenue is growing very fast and they're pointing to this big opportunity to grow globally, and that's great, and their share price goes up a lot, but then they have a disappointment for some reason, and I can tell you from experience, all small companies growing have disappointments at one stage or another. It doesn't mean they're bad companies, it just means that they have a difficult 6 months or whatever it might be, but they have a disappointment and the share price tanks because everyone loses confidence in them, and then it becomes very difficult for them to raise new capital because the share price is so low, and they're sort of stuck. They become a bit of a sort of listed zombie. So that's a real risk that we don't think these private companies should take. And so we think it's better to stay private for a bit longer.
Okay, so what are the stages that these kind of businesses go through before they get to listing?
Yeah, it's a very good question because actually they go through 3 stages always. And it's actually not just as they get to listing. It's when they're listed, they're still often in the stages. And the 3 stages are startup, growth or expansion, acceleration of growth, and eventually maturity. And in startup, the businesses have really, in the technology space, they've written their code, they've written their product, they have a product, but it's often a beginner's product. They need to build on the product and develop it. But they're solving a particular problem, they've written the code, they've got an information technology-based business, and then they go out and they start winning customers. And then the customers, usually it's just the founders, a couple of founders and 1 or 2 other people with a little bit of money from friends and family and their own savings. And that's really a pilot stage of the company. It's really getting established, trying to understand whether their good idea about what problem they were solving for customers is actually going to work. They've written the technology which solves the problem on paper, but they now need to go out, or at least solves the problem digitally. They now need to go out and get people to pay for it. And so that goes on for quite a while, 2 or 3 years usually in the startup phase, where companies are trying to get to a certain phase. Once they get sort of a little way through that, in other words, they've built a customer base of perhaps 20, 30, 40 customers, and you can see the economics of it. The customer's paying a certain amount and it's costing us a certain amount to win that customer. And then we have a certain amount of ongoing cost to service the customer. And you can see that that's actually profitable. Each customer is actually profitable. Then the companies look to scale up a bit. In the early expansion stage, normally companies will get sort of $500,000 from an early VC or from angel investors, which are, in the jargon of tech investing, angel investors are wealthy individuals mostly who do exactly that, put somewhere between $100,000 and perhaps $500,000 into these startup companies, and they put them into lots of companies, seed lots of companies as the jargon goes, and then some of them succeed and some of them don't. And then, so that's the beginning of the growth or expansion stage, and then you get into the more expansion stage or growth stage proper, and that's when we would come in. And that's when companies typically would have 20, 30, 40 employees by the time we invest in them, have got that sort of $5 million of revenue, have got started to get good business processes and good reporting, and have started to go international. And then from then on, it's right into expansion and growth. And expansion and growth means adding more people, usually particularly in the sales side of the business.
And you have to be very careful, presumably, at this stage.
You have to go step by step. You have to understand, again, I keep coming back to the economics of growth. You have to understand how much we can charge a customer in a new jurisdiction, how much it's costing us to win that customer. So you need to just take it carefully and put a few people on the ground and build up the business and get to understand. Sometimes in those markets, it may be better than going direct. It may make sense to go through a partner, for instance. You need to understand that.
Because this is the key to it. Businesses these days are not about building a factory and then producing something. It is acquiring customers. That's the key to so many of these kind of businesses, isn't it? Yeah, it's so in technology, in the information technology space where we work, it's about seeing things being done inefficiently in the physical world or in the old world, in the legacy world, and understanding that there's a better way to do it. That's probably 2/3 of the opportunities we see. The other third is just something completely new. And again, in our jargon, it's called white space. No one's doing anything in the space, but you can create a new product or a new model. Social media would be a good example. There's no such thing as really social media unless you counted going to clubs and talking to a smaller number of people. But social media was created because there was just a new idea and new opportunity, and connectivity, the fact that we're all connected one way or another through the internet, allows social media to exist and didn't exist before. So that's a big part of the new businesses. They're just new businesses that are built on in new spaces that no one had ever thought about before. But a lot of what we do is taking inefficient legacy practices and doing them much more efficiently. You're finding businesses that require funding to continue to grow, but and you take a role in actively managing them as well, don't you?
Yes, that's a very good point. The two absolutely go together in our philosophy of investment.
You're not just giving them money and then letting them fly away.
We invest in fewer businesses at a later stage, so more mature businesses, bigger businesses, and we get deeply involved in helping them improve, because in the end, they need that. It's not just the capital they're looking for, it's experience in building businesses. And my partner Paul Wilson and I founded the fund about 7 or 8 years ago now, and we both got extensive business management experience. I, as you said in the introduction, came up through a whole range of senior business management roles in big companies, including Fairfax Media, and Paul worked in private equity for an extended period of time. So private equity buys the whole company generally, and usually uses debt to do that. We don't use debt at all, but they use debt and they buy the whole company. But then they get involved in at least setting the company up for success by doing lots of analysis and putting in place a good business plan, solving problems as they go along, even though they have professional managers actually managing the business. So both of us had lots of experience in business management as well as investment, and that's what we do, and that's what we like doing.
Do you have any practical examples of where you've done that? A specific example that you can give us, for example?
Yeah, I think, a very general example is finding people. Turnover in people is quite high, and we all know that the return on investment in the best chief executives, or it's not really so much chief executives because that's usually the founders, but the best chief financial officers or chief operating officers or chief marketing officers or head of sales are difficult to find. But we've got lots of contacts and lots of people we know to talk to, so we've proven very good at finding people and getting people to join the companies that we've invested in, and that's been a huge benefit to the companies.
So being able to bolt in exactly the right roles, the people for the roles that are required to run these businesses.
Yeah, exactly, and being a partner with the founders and sitting down and helping them understand what skills they need at what stage of the company. Because we've been in the business long enough now to see it pretty regularly. We know when the current chief financial officer, who's just been mostly, making sure counting the money and making sure that the bookkeeping was done properly, needs to move on, and we need to find someone who's better at either raising more money or can take on a much bigger commercial role in the company, opening new offices overseas.
You do have a very specific list of criteria that you use to decide which companies you're going to invest in.
Yes, we do, and it starts, as I said earlier, with scale. We don't really invest in any companies with revenue less than $5 million. And it's not the revenue per se, it's the maturity of the company that signifies, which means that they have established technology, so they're not still trying to build their technology and figure out if it works. It does actually work. They've got a fairly large customer base, pretty established customer base, and we can see that customer base sticks with them. And the customer base is rebought, if you like. They realise that this is the best solution they're going to get, and they're going to stick with them for as long as they can. So that's very important to us in terms of the maturity and scale of the company. The business economics is very important to us, understanding the profitability, and that starts with the gross margin, and then comes through the cost of acquiring customers and the turnover of customers. We want that to be very low.
So if we could just look into those specific terms, gross margin and cost of acquisition.
Yep, sure. So the gross margin is the difference between the price that you charge the customer and what it charges you just to sort of keep the lights on and deliver the service. And that, generally speaking, in technology businesses is the infrastructure costs of running the business. Sometimes that's also the customer acquisition costs can be put into that gross margin, or the marketing costs associated with acquiring the customer can be put into that gross margin calculation. And what you find in a lot of technology businesses is the gross margin is very high. It doesn't actually cost you much just to keep the lights on serving the customer, because you've already built the technology, you built the tech, built the software, and now you sell it to people and the software just runs. There's obviously investment and updates down the road, but basically, the current serving of your current customer base is very cost effective, and gross margins and software as a service, which again we'll come back to explain.
Well, maybe we can talk about software as a service right at this point.
The gross margins tend to be around about 80%, high 70s or 80%, and that's really high. And a physical business that has to actually buy raw materials, turn them into something and then sell them, has a much lower gross margin.
Yep. So software as a service, these are all businesses. Yeah,
software as a service. So traditionally software was written and delivered to people who used it to load onto their machine, onto their computer.
On a CD-ROM.
On a CD-ROM, or a floppy disk, even before that. So you actually had, MYOB for small businesses would write their software, they'd put it onto a floppy disk and they'd post it out to small businesses, and then they'd put it into their CD-ROM, they'd put it in and you would upload it and it would be on your machine. That's a very inefficient way to deliver software in the end, and because the internet's now got so good and you can transmit so much information over the internet in such a short period of time, now you don't have to have the software physically loaded onto your machine. You can log into the software when it's effectively loaded into, or it's stored in what's called the cloud, which is really just a network of servers and other hardware.
Physical hardware,
yep. which you can put your software on, and then through the internet people can go to that space and they can operate the software as if it was loaded onto their computer when it actually isn't. They're just doing it over the internet. So software as a service is that business model in all sorts of applications. Xero, for instance, which many people have heard of and know about, it's accounting software. That's all delivered out of the cloud. So
it's interesting that you brought up Mind Your Own Business as an example, because really Xero has superseded Mind Your Own Business, hasn't it?
And the main reason these companies they supersede the new wave of technology supersedes the old wave of technology for two reasons. One is they have better functionality. They just do more. And the software as a service software, the way it does more is be more connected to everyone at the same time. So as a small business owners will know that when they're doing their software, they can complete updating things on a daily basis. Their accountant, for instance, can see that in real time. And your accounts can be keeping up with your bookkeeping or your cost entering or your sales entering every day. So that's one of the ways in which the functionality of accounting software as a service is better than software as a service loaded on your own computer. But the second way is cost. It's just much cheaper. So the price of everything comes down as well.
I think at this point, Liv, we should talk about some of the companies that you're investing in at Bailador.
So software as a service not only has very good economics of growth, in other words, high gross margins and relatively low cost to add new customers, and those customers, if you've got a good product, stay for a long period of time. So the subscription revenue that you get from those customers compounds over time, and you find that you get that wonderful asymptotic growth curve.
What's that? What's that word?
Instead of just being a straight line, the growth curve gets steeper as it...
Logarithmic sort of thing.
Logarithmic, exactly. Mm-hmm. Logarithmic growth curve from software as a service, because you've got the compounding effect of customers that you've added 1 or 2 or 3 or 4 or sometimes 7 or 8 years ago, which are just still there, and you charge them every year, but you don't have to, you service them, but only very generally. You don't have to win them, or there's no more cost associated with those customers. So software as a service has very good growth economics. So that's what we've mostly invested in, and our most successful investment is a business called SiteMinder. I should go to the punchline on SiteMinder first, and that just before Christmas we raised capital, at least the company raised capital, and we supported it strongly at $1.1 billion of market, or it's not market capitalisation because it's not listed, but it's a private company, and that business was in the small tens of millions of dollars when we first invested about 7 or 8 years ago in terms of its total value. So that's been the growth. That's been the sort of over 20 times.
And what does SiteMinder do?
SiteMinder provides software for hotels to connect them to all of the sources of potential room bookings. So if you're a hotel and you want to connect online, you need to connect yourself to Booking.com, to Expedia, to Agoda, to Ctrip, the big Chinese companies, to Trivago, to the Trivago girl, to Hotels.com, to a whole range to other places like Airbnb also is now part of it. But you need to connect to as many potential sources of people looking to book your hotel as you possibly can. And not only do you need just a sort of simple connection, you need to be able to communicate the details of your room availability, so what rooms are available when, what the price of the different rooms are, which ones face the sea and which ones face the mountains, and all the other extras that you have in the room. So there's quite a lot of information that needs to be communicated through.
So if we could just look into this a bit deeper. So someone at reception has access, is that how it works?
That's right. Well, someone that has access to what in the hotels is called their property management system. So the hotel's a property, and they have a property management system, and that manages the stay, it manages the booking, and when someone books in, and that booking can be someone walks in and say, I'd like to book a room, or it can be online. And so connecting the online bookings to the hotel's bookings management system, as well as the restaurant in the hotel, the anyone that uses the minibar, someone that goes to the gym, anything else associated with the stay, so that they can send you a bill at the end or give you the bill at the desk at the end, and make sure you're in their CRS, which is their customer relationship management, their CRM, so they can send you follow-ups and you can be in their loyalty program and all the things you get today. All of that is on the hotel side. What SiteMinder does is connect all of that to all of the sources of bookings. And SiteMinder is really a warehouse which stores all of the room availability for a particular hotel, or for 36,000 hotels, which is the number that it's now got. And then anyone from anywhere in the world can connect to that warehouse and they can see all of the availability of all the rooms on 36,000 hotels all around the world.
And this was just a couple of young founders did it here in Australia.
Yeah.
Is that right?
Yeah, it's amazing.
It's extraordinary. You sort of think that this would be something that would come out of Silicon Valley or one of the great tech centres around the world.
Well, it's a great story because they were both in the tech industry. They were working for a sort of a tech services type business. And one of the two founders, and it's typically a product and market person and a technical person, a code writing person, is typically what we see as the two founders. The product and market person, Mike Ford, who was the CEO for a long period of time, he had a friend who had a backpackers. And he used to go along and see his friend and they'd have a few drinks at the weekend and so on. His friend was constantly complaining about, oh God, it's so bloody difficult. I'm trying to manage my bookings and I've got to connect with now everything's happening online with young people booking in the backpackers, and he had 2 or 3 backpackers. They were having to connect directly with Booking.com, Expedia, all of the different lines. So they had to write code to connect to all of these people differently. And then they had to have someone monitoring the availability of the rooms as they were on each of these potential booking sources. So that, if someone walked in and just booked it overnight, they'd have to ring up, or at least probably go online or send an email to Trivago and Booking.com and all the rest of them and say, take one room off because someone just walked in and booked. So it was very inefficient and quite costly. And it meant that they had to not put all of their rooms on all of the potential sources of bookings. So Mike thought, yeah, that's really inefficient. So they went away and with the other partner, Mike Rogers, they started to write the code and started to go around and start to talk to hotels and got immediate pickup, and off they went. And we joined them when they had about 5 million of revenue, and they were just about to they wanted to open an office in London. In Asia, they'd opened a very small office in London, and they needed our money, and we put sort of $5.5 million or so into them, and off we went.
And what share of the market worldwide would they have now?
Well, it's still small.
Yeah.
Because there are around 1 million hotels worldwide. Many of them are long tail of small hotels, and only about half of those are currently online. Mm-hmm. But I think they are the dominant provider in this market.
Is there any competition in this?
There is small competition around the world in other places, but they are far and away the leader. They're triple the size of their nearest competitor in terms of number of hotels connected, and in terms of number of systems that they are able to connect to, number of property management systems they can log in, they can connect with. So they've got the best position they could possibly have.
Yeah. Does that make them a unicorn? Are they a unicorn?
Well, they're an Australian unicorn. Unicorn for people is companies that have passed the valuation mark of $1 billion. Mm-hmm. So yes, in Australia they are a unicorn.
Okay, it's like it being in the top 40 in Australia. It's not the same in America.
No, it's not. You wouldn't quite be a unicorn in US dollars.
Not in US dollars. Yeah,
we're on the way, and the business is continuing to grow strongly. Yeah, and it's very interesting. 80% of its revenue comes from outside Australia and New Zealand. Mm-hmm. So it makes you realise it's been global for a long time. It's competed with the best globally, and it's won. And now it's got to just continue to double down on that.
Okay, you've started investing in the share market. Now, how do you track trades, dividends, distributions, and franking credits and all those other goodies? Just throw away those clunky spreadsheets with Sharesight. I have my portfolio on Sharesight and everything is automatically recorded. Sharesight are pleased to extend a special offer to listeners of this podcast. 2 months free on an annual premium plan. Go to sharesight.com/shares for beginners and sign up now for a 7-day free trial. That's sharesight.com/shares for beginners. Straker is another one. That's an interesting business. They're listed on the stock market as well, aren't they? Are they the only one of your companies that's listed?
Yes, the only one that we've listed directly out of the fund. So we've held our position. We've sold down about 10 to 20% overall. Just, it's important that we realise cash for our investors over time.
Yep.
And that's part of our model to make sure we do that. But we're a big believer in Straker, and we think that's got a long way to run.
Okay, tell us a bit about Straker.
Yeah, Straker's in the language translation business. And language translation is a huge global market. It's a $42 billion market, growing at around about 8 or 9% a year. And you might say to yourself, well, why is language translation growing so fast? It's because of cross-border commerce. Everyone's now, because of the internet and the ability to sell in multiple markets, people are able to sell in markets that speak a foreign language. But that means they need to put their website, and they need to put all their marketing material, and they need to put all of their packaging material needs to all be translated. And because there's much more cross-border commerce, there's also lots of agreements. People are putting in place agreements to do things in other languages, and that all needs to be translated. So lots of global commerce, cross-border commerce, is causing lots of demand for translation services. The typical way in which translation has been done has been by people who have got degrees and deep understanding of the languages, and they've accreditation, yep. Exactly, and they've translated out of their mind. Not too long ago, there was the machine translation came along, and many people will be familiar with Google Translation. But if you typed any string of things to be translated of any amount, 2 or 3 sentences, into Google, you'll find it comes back pretty jumbled. It gets the general gist of it, but the actual specifics of many things are not right. So what Straker decided to do about 6 or 7 years ago, the Straker Translations did, and it's founded by Grant Straker and his wife Marin. They thought that they needed to combine machine translation with people translation. But they realised that employing people was an inefficient way to do the translation, so they crowdsourced. And so they've set up a platform, and the key for them and the key for the business was to build a platform which allowed for very efficient loading of the material to be translated into it, for then everyone to have visibility of that in real time, for that to be immediately and automatically machine translated, using all the best translation engines, including Straker's own translation engine, which is now as good as any in the world and getting better because of their billions and billions of strings they've translated. Machine translation for then
so the machines are learning the translation.
They're learning the translation as they do it. Yeah. Right, the more they do it, the more they translate, the more they realise what that word next to that word looks like and what the context will be. Wow. Not sure they're ever going to become able to replace humans completely, but they're getting there. Mm-hmm. And then at the same time as the machine translation is being done, which of course is very quick, there's a crowdsourcing of human translators, and the work is, there's an agreed form for selection of the 2 word pairs, and there's 80 source languages and around about 80 target languages. So you can go literally from German to Swahili and Russian to some other Tongan. Yeah, exactly. Yeah. And literally you can do all of those languages, but you need to find the translators that know those 2 languages. Mm-hmm. But those are all crowdsourced, and there are tens of thousands of translators that are on the roster, as it were, and they all pitch for the business because something comes up in their email, bing, would you like to do this business, or a text or something, and they say, yeah, I'd like to do that. And so they come back very quickly, the material sent out to them, they tidy it up, they make sure that the machine translation is perfectly accurate and got the context right, and it goes back onto the platform, and then it's concluded, and then the person who's put it in and uploaded it can then it's available to them, and obviously they pay a deposit up front, and then they pay the rest of it, and they can get their translation out. And Straker is very cost effective because of the efficiency with which the business is able to deliver that translation service. And so the business is very successful, and it's continuing to grow well. It acquires customers organically online and by becoming the preferred translation provider for large multinationals who need to have a lot of translation done, and also for governments. And it's added on a media translation arm in the last year, meaning subtitles and other translation for media that needs to be
like when you're watching Netflix or something.
Yeah, exactly. Because again, there's a whole lot of media and film and that's being produced for other languages now. Yeah. And so someone needs to translate that, and they bought a company that's great at doing that, and now they've moved into that market.
Is Bailador what you'd describe as an LIC, a listed investment company?
Technically it is.
Technically it is, but it's not like...
But it's not like any of the other listed investment companies. It's really much more like listed venture capital or listed private equity, in the sense that we invest in private companies and we hold them in a portfolio that investors in the one listed share, Bailador Technology Investments, BTI, can get access to. So people investing in BTI get access to 10 private companies, or actually 9 private and 1 listed now, with Straker being listed, and all of the growth that goes along with that. Listed investment companies typically just invest in other listed companies. So there's a lot more, if you like, uniqueness in what we do, and the valuations of the companies in our portfolio are not just pass-through valuations from other listed companies. They are conservative valuations of the value of a private company. And we do that by marking to third-party investments. So if someone invests in the private company, then we will mark to that valuation, or there's a sale of part of the company we're invested in, we'll mark to that valuation. It's a cash-on-cash measure.
So just to simplify that, I believe that what you take great pains to do is you want to make sure that investors are actually making money out of these investments, aren't you? That's what it comes down to.
Absolutely what it comes down to. So we want to make sure that we are holding the investments at a conservative valuation, a lower valuation than we feel very positive about realising the company's at. We're going to get more for this company than we're currently holding it. Because it's very important for us and for people's confidence in the fund that when we come to exit, we sell at a higher price than we're currently holding.
So what are you personally getting out of this? I mean, apart from the financial, obviously, but how does it make you feel working with these kind of companies and going through this process?
Well, I think there's 2 things. One is Paul and I started the company from zero. We sat in a room together and thought, how are we going to start this business? So we feel we have quite a sort of compatibility and understanding of what founders go through, and we built the company up over the 7 or 8 years to today, and we see it as in a great position to accelerate its growth from here. But the other thing, I've always been a business manager. I've always taken a lot of satisfaction out of growing businesses. I've been business manager and I've been a growth orientated business manager. I don't like just winding things down or managing for cash or anything like that. I want to see a business grow, which means being innovative, finding new products and seeing the people blossom within the organisation in a growth environment. Because people they get such excitement out of being part of winning companies, and that's what I enjoy doing. And I'm at a certain stage of my working life where I've scraped my knees a few times and made a few mistakes and had a few great wins. So I'm delighted to hand that back, to pass that back, and to be able to give good advice and to be as helpful as possible to these companies and to help them fulfill their dreams. It sounds a bit corny in a way, but really, a lot of, particularly the founders and the people that get with them, this is what they've decided to spend their life doing, building a company from scratch. And
they're passionate, aren't they?
They're totally passionate, really passionate. And to be able to, it's a real privilege and very satisfying to be able to, pass on wisdom and knowledge that helps people, get to where they want to go in life. I get a lot of satisfaction out of that.
David Kirk, thank you very much for coming on the podcast.
You're very welcome. I've really enjoyed it.
Shares for Beginners is for information and educational purposes only. It isn't financial advice, and you shouldn't buy or sell any investments based on what you've heard here. Any opinion or commentary is the view of the speaker only, not Shares for Beginners. This podcast doesn't replace professional advice regarding your personal financial needs, circumstances, or current situation. Thanks to Christopher Soulos for music production with that special Greekalicious flavour. Remember, music always flows, even when the money won't.